we've been through a global financial crisis, and I think it's fair to say beforehand we would have lent to the residential sector to some extent, but obviously we built a lot of offices, we built a lot of shopping centres. At the moment, we don't build so many of those, and residential has become far more what our clients are doing. And to a large extent, we're driven by what our clients do. And obviously, we go out and prospect, but ultimately, we have a core client base, and if that's where they're heading towards, we follow them and acquire the skills to do that. I work on the developers team within Lloyds, so it's very much focused on project-style developments where you've got a scheme which you're going to build. There's a start and end date, and it perhaps takes 3 years to get there. But that's within Lloyds, and there's a wider exposure to residential through the Housing Association, the RSL book, and through house builders as well. Back to the developers team, at the moment, we're very much looking at what I call sort of mid-market for sale across the UK. For example, we have colleagues working with Generator LLP, and we're funding developments in Norwich and in Bristol. We have Wilmot Dixon, and we're working with them in Godalming. Across the UK, there's a lot that we are doing. Myself, I've got a couple of transactions in mid-market-ish transactions in Manchester, one PRS, one for sale. So there's a lot that we are doing. There is, of course, Prime as well. Prime is, I suppose, more London-based. It's a more difficult market. It's more case by case, I suppose you call it. You select who you work with. There's all sorts of people out there trying to convince you that there's good prime to be done, £2,000, £3,000 a square foot. And believe us, we're not going to sell any of them before we complete the development, because they'll obviously sell for far higher prices in 3 years' time than today. That sort of story doesn't really work for us. You've got to be very selective in the prime market. But in the mid-market, across the UK, selling to you and I, people that work and live in the UK, that's really our core market, and that sort of fits very well with our CEO's desire to help Britain prosper. We're a key part of the UK. I can't say we have an obligation or a duty to lend to house builders, but we're very into house building. But we're very keen to be there, and we see it at the moment as being a good business to play in. PRS is definitely a new asset class, absolutely, and I think that is a key part of it. It's if you look at who's out there, there's people like Get London Living with about 1,200 units. You've got Fizzy Living with 250 units. And then you've got people sort of coming through, people like Essential Living that have probably got, probably in the region of 1,000 units coming through, but are actually being developed. So the market is very much one of development finance from the time being, and it may well be the case for the next few years that it's development funding. That's great for me because that's where I work. That is going to be the driver for it. There will be a period when sort of further on when it moves more into sort of stabilisation, where the buildings are complete, they're let. But at the moment is very much development. And I think within that, there's perhaps a couple of points to make, one of which is the risks are slightly different in development for PRS and for sale. If we're doing residential for sale, then you have got some pre-sales of the flats or the houses on day one. If we do an office development or a retail development, we know there's going to be some pre-lets on day one, before the loan is drawn. If you're doing PRS, then you don't really know what the client base is like. You don't know what the rental tone is going to be like until perhaps 2 or 3 months before the development is complete, which is probably 2.5, 3 years after you've advanced the money. So that is quite significant additional risk, which perhaps isn't always understood well enough by some of the potential clients out there. And in addition to which, there is in the operational aspects afterwards. How successfully can people run a PRS scheme? What is the gross to net leakage? Some important points which will come out in due course, but at the moment, there's not enough out there to be sure of how those things will work out. I think there will be a lot more to happen. I think as more gets built, that's good. More stock comes on, it moves off into stabilisation. There'll be then more developments coming through, and maybe in 3 or 5 years' time, we'll start to see portfolios trade. And I think at that point, it becomes a lot more interesting because for us as Lloyds, we look at it and think, well, there's a great opportunity there, because if you had a portfolio of maybe in total, say 500 million, perhaps 2,500 units, there's perhaps a £250 million development, £250 million financing requirement. And at that point, well, there's an awful lot of long-term money looking for good returns out there and safe returns. You can imagine there's perhaps a 10, 15-year bond that could be put on the back of that. And in that sense, I see that the PRS market may well evolve into in 5 or 10 years' time to where the student accommodation market is today, which is to say that it's an accepted market. Raising long-term debt against mature assets is perfectly doable and reasonable. And there are opportunities where Lloyds would be very happy to play a role. The implication, I suppose, is that interest rates rising is inherently bad. a bad thing, I suppose. But and yet, if you look at what would cause interest rates to go up, why would Mark Carney decide to raise interest rates? Well, presumably it's because employment figures are still looking good, if not looking better. So if you've got more employment, there's going to be more demand for office space. I think 80% of the UK economy is office space, in which case rents will be growing. There'll be demand for more office space, retail space no doubt as well, more development to come through, which all sounds reasonably positive. So I think rate rises, yes, they may be not too far away, but I don't think they're necessarily a bad thing of themselves. It's what accompanies them, and at the moment it looks as if it may well be generally positive things. As for the wider market, it's difficult. I'm not an economist. I'd look at it and say, I think property is supposed to trade at a sort of 200 basis point risk premium to treasuries, to gilts. Gilts, I think currently 10-year gilts are about 2%. Add a 200 basis point premium and you're up to about 4%, 4 and a bit, and the net initial yield on good real estate is about 5.5. So it would strike me there's quite a lot of room to absorb some sort of change in the interest rate structure. And as I say, if it is the result of strong growth in the economy, that's not a bad thing.